Okay. Well, good evening, everyone. It's the 16th of March, 2023, and the year has started off very with a bang. So we're getting used to that now. I think every year around about February, March, we can expect a little bit of excitement and quite a few changes in what's expected in the world. So I think the current jokes that are going around are mostly about inflation, and people are wondering why there's such a demand for inflation jokes. Well, it basically, the demand is followed by a period of higher interest. So that's what we're seeing now, is a period of higher interest. The Federal Reserve, the ECB, Christine Lagarde just went ahead anyway today and announced another 50 basis points increase in their interest rates, forgetting or not worrying about the possibility that some major banks are really in trouble. Fortunately, tonight we have two gentlemen that can make sense of it all for you, ease your concerns, and make you feel that you're in good hands and that everything will, in fact, this too shall pass like everything else. So we have first for you this evening will be Grant Morris from Clucas Gray. He represents one of our components in our local SA equity construction of our funds of funds. And they have Clucas Gray, Grant and Andrew Vincent, his associate portfolio manager, have produced fabulous results over the last couple of years. And we've been very happy to be on board with that fund. Our second guest tonight is Tony Bell, who probably needs no introduction with most of you, most of our clients. But we'll do that introduction when we get to that in the second half of this webinar. So where I'd like to start then is to welcome Grant and to say to Grant Morris, thank you very much for coming to speak with us. I think we've now got about 80 participants on board, and the next few should be here. We're almost at 5 minutes past 6. So I think that will be a good place for us to start. I'm going to start off by introducing you, Grant, and that is to say that you've been in this industry for about 22, 23 years. And apparently you started at a really good time, just around about the time that the tech bubble burst, and you saw one of the biggest stock market crashes of the 21st century. And then 8 years later, we had the great financial crisis, and another 12 years later, we had COVID, and then 2 years after that, the Ukraine war. So we're just wondering what you have in store for us this year. But what have you got up your sleeve? Yes, you've got a fantastic work history with Standard Bank, Melville Douglas Investments for 16 years. And then you joined Clucas Gray in 2015. And no doubt that's been a fantastic experience working with Andrew and building up this local equity fund along with your other equilibrium fund. So Grant, I think that's enough from me to introduce you and to welcome you and say thank you very much for coming. And we now have 81 participants. We did have approximately 150 who made bookings. We usually end up at about 100 anyway, 110. So I think we're getting there. The numbers are just about at the point where I would say it's over to you, Grant. We'll chat in about 40 minutes. Okay.
Excellent. Thank you, Jim, and thank you for the introduction and indeed for the invitation to speak to you this evening. I'm grateful for that invitation from yourselves. And as the topic has highlighted, I've been asked to speak about the local equity outlook and landscape, and how we're seeing that landscape, and how we positioned within South African equities to try and navigate the landscape. So I'll take you through a few of our thoughts, and I will then try to leave in and around 5 to 10 minutes at the end for questions. Maybe if I could just very briefly introduce you to Clucas Gray Asset Management. This is a small boutique asset manager. We manage approximately 14 billion rand of assets on behalf of a number of clients and institutions. And as we would describe it, we feel that we are large enough to invest in a well-resourced investment team. That's a team that comprises 13 research analysts and portfolio managers, but we're small enough to take advantage of a wider array of opportunities, and we'll try to depict some of that for you this evening. At a high level, we have a fairly simple investment approach, or an alpha thesis as we call it, where we believe that the key drivers of a share price are really two things. One is that we look for businesses where they can deliver real growth in their earnings, in their dividend flows and their cash flows, and where we can get a change in the rating or the PE multiple or the valuation that we pay. And so we would certainly describe ourselves as valuation obsessed. We think that the starting point and entry price is critical to earning a return. And we think that if we can invest in businesses that have, long-term structural earnings tailwinds, and we pay the right price, that to us is the way in which we can generate decent returns for clients over time. As Jim alluded to earlier, our key equity fund, the Clucas Gray Equity Fund, is run and managed by myself and my colleague, Andrew Vincent. The fund has been in operation since October 2011. Andrew and I have run the fund together for about 8.5 years. And as at the end of February, the fund had around about 1.1 billion rands worth of assets. I want to move on to firstly describing what we see as the investment outlook and macroeconomic outlook. I won't spend too much time on global issues. I think that Tony will more than eloquently cover that. And really what I would like to then do is translate that into how we have positioned the South African equity component within the fund. So what I might do is just start briefly in terms of a growth outlook and just cover what we're seeing globally as well as domestically as a starting backdrop. We certainly think that the global growth trend is going to be weak in 2023, and we think that this trend growth, as we would call it, is going to be lower than what we've become used to over the last few years. The chart on the right, we think, illustrates this quite neatly, where it breaks down growth around the world into a number of decades, and it breaks it down into mature economies, emerging economies, and global economies. And what you can see on the right-hand side there is that our sense of it is that the world is going to be stuck in this growth range of somewhere between 1.5% and 2.5% in the near term. Picking the exact number, of course, is not that important. It's I guess the trend that we're looking at. We think that emerging economies, the dark blue line, should recover into the course of 2023 and into 2024, led by China. And onto the South African landscape, we think that the South African landscape looks as if it will produce very modest and benign growth, particularly at a household consumption level. We think that growth will be very modest. We do, however, see a little bit of a pickup in the potential for fixed capital formation spending to improve a bit, and I'll come to that in a minute as to why. I guess the caveat to some of this is that if we see a very sustained period of load shedding, those growth numbers could certainly be at risk. More specifically, this we find quite interesting with regards to the South African context. We feel there's really absolutely no way to sugarcoat the effects of load shedding, the effect this has on growth, and importantly on confidence, because confidence is a critical part of the investment landscape. What is, however, clear to us is that there is quite compelling evidence that spending on alternative energy supply is a potential bright spot for fixed capital formation. And quite clear, if you look at that chart on the left-hand side, there is quite compelling evidence that spending on this is already underway, and it has changed extremely quickly. That chart shows the imports of solar panels and lithium-ion batteries. And what you can see is just how quickly that has changed in the last quarter of 2022. And we think this is going to continue. We think that the recent announcements from the budget, particularly for companies, where they're able to get a rebate, is going to change the landscape for supply coming out of the private sector. That chart on the top right-hand side just shows you exactly how quickly non-Eskom supply has grown over the last 2 to 3 years. And we think that there is a chance that by 2025, and I'm now talking to the table on the bottom right, that the supply that comes from a combination of the REIPP program and other industrials private supply could mean that within a 2 to 3 year time period, supply from non-Eskom sources will pick up dramatically. That doesn't mean that the near term is going to be easy, but we think that 3 years out, the picture on this looks somewhat easier than it has been over the last few months. The one aspect that we think remains too high in South Africa are our bond yields. You'll see that our bond yields are sitting at about 10.5% as we stand. We do think that domestic inflation, the chart on the bottom left-hand side, does come under control into the second half of the year. We don't think it falls quickly, but we think that it comes to within the 4 to 6% band, hopefully by the second half of this year. The chart on bond yields on the right is important because we really need to see the cost of capital come down in South Africa to be supportive for investment and to be supportive for equities. And so certainly we think that if that does behave and begins to come down, then we can enjoy a better backdrop for domestic equities. Just a very quick word on the South African consumer backdrop. Difficult space for the South African consumer. The top left-hand chart shows you that there has been, some wage growth coming through more recently, admittedly off a low base, but some improvement in wage growth. And then the bottom chart there just shows you what is happening in the credit space. Real credit, in other words, growth in credit above inflation, has really gone nowhere for the better part of the last 5 to 6 years. We are seeing some early signs of life in real credit growth, but not enough to really get overly excited about. And we think that if inflation falls, then we could get some better behavior out of real credit growth, and that tends to be a stimulant for economic growth. Just a word on the currency. I know that this is always topical, and I think that we are very wary of betting any form of one's career on currency guessing. It's a hazardous occupation. Other than to say that the US dollar has been extremely strong for more than a decade. You'll see on that chart on the right-hand side, that is the real effective exchange rate for the dollar, and we are coming off multi-decade highs. To our minds, it doesn't really matter if you are looking at purchasing power parity for the rand, or for the euro, or for the yen, for that matter. We think that the lion's share of the dollar strength is likely to come to an end, but probably only after the rate hiking cycle has finished in the US. A couple of charts and slides on commodities. It's critical, we think, in the South African landscape, given the importance of commodity shares in the index. We are seeing some mixed signals in the commodity markets. As we know, platinum, palladium, rhodium have enjoyed a very strong period over the last couple of years. And what you can now see in that chart on the left-hand side is that both palladium and rhodium are certainly coming off higher levels, particularly the spike that we saw during the invasion of Ukraine. Counter to that, however, and we think that this is largely some kind of a response to China reopening, we have seen the iron ore price and the copper price respond in a more positive manner. They've picked up. Copper is the red chart, and iron ore is the blue one on the right. Those have responded a bit more positively, and that's important for a number of the diversified miners in South Africa. That, of course, some of that, of course, has changed in the last 5 days. But what we think is important is to keep some longer-term commodity issues in mind. The first we think that is quite interesting is copper's long-term outlook. And the right-hand chart just shows you how significant China's share in the global commodity demand actually is. In many of those key commodities, China's share of demand exceeds 50%. Copper is among them. Iron ore and aluminium are two others where it is very significant. And so for the commodity basket, China coming out of lockdown and reopening is an important thing to watch. The other long-term trend, which we think is very supportive for copper, is that you'll see in that left-hand chart that copper really is a critical ingredient for any energy transition projects, and whether it's wind or solar, that it really does consume a decent amount of copper. And this is why we think that maintaining exposure to some of these diversified mining companies and copper exposure is important. Companies like Glencore, Anglo American, BHP Billiton all have decent copper contributions, and we think you've got to keep the long-term trend of this in mind. It may bump around in the short term, but the long-term trend we think favorable. Then maybe just something on oil. If you look at this right-hand chart for a minute, those gray bars are recessionary or slow growth periods. The blue line is the oil price. What is noticeable from this is that in all prior slower growth periods or recessionary periods, oil has fallen. The price of oil has responded very quickly to that, and we've seen that now. And so the oil price decline recently, we think, is consistent with prior recessions and slow growth periods. What we think is quite important this time around is that the combination of China reopening together with quite an underinvestment in oil and gas exploration, and you can see that in the bottom chart on the left, that exploration spending in oil and gas has really collapsed. What we think that means in due course is that when demand recovers more fully, there may not be as much supply to meet that demand. And so our medium to long-term outlook on oil and energy prices is favorable. What I would now like to do is just move from the macro aspect and try and put this into real life investing practicality and how we take cognizance of what's happening in the macro environment. But in reality, how does it translate into a portfolio and what we're doing in investments? We have an investment process and an approach where we are trying to look for assets and asset classes which can generate returns for clients at a rate of inflation plus 4%. So we always want to be trying to aim for, and we use the upper end of the band for inflation domestically. So in rough terms, we are always aiming to try and get 10% and higher out of any asset class to make it attractive. And this exercise that we go through uses a number of assumptions. It uses earnings prospects and growth prospects, and it uses things like ratings. And we try and take a 3 to 5 year view on this type of positioning. We think doing it more shorter term is a lot more difficult. And what you'll see from this picture on the right-hand side, those Manhattan charts, is that this bottom-up exercise for us at the moment certainly features South African equities quite strongly. You'll see the all share on the right-hand side, things like banks, JSE banks, South African bonds. We think that those asset classes at the moment are in a position to generate decent returns for clients, and I'll try and delve into why in the subsequent slides. This, we think, is a very interesting chart to keep in perspective. It's a historical chart which goes back between 1960 and December 2022, and it just illustrates the turquoise bar that you'll see there. That is the returns of South African equities. That blue line is inflation. And we find it remarkable that over varying periods of time, South African equities have been able to deliver real returns in excess of inflation over many rolling periods. And it's sometimes, difficult to believe when we look at the domestic landscape. And we think, this speaks to two things, really. One is that there is quite significant diversification of the South African earnings base, in that it is not solely reliant on domestic GDP issues to drive its earnings. That we think is important. And the second thing is that we must give credit to South African management teams who are nimble, maneuverable, and somehow over time have managed to grow earnings at a rate above inflation. If we now move into some of the aspects of valuations on South African equities and why we think they are positioned to deliver returns, much of it has to do with the fact that we think over the last few years you've experienced what we would call a derating of South African equities relative to other markets around the world. So, for example, the chart on the top right-hand side here in blue shows you that is the 12-month forward dividend yield in South Africa, which sits at around about 5%. The comparative number in the yellow line there is for emerging markets. That sits at 3.5% roughly. So it's a significant difference between emerging markets. If you had to go and look at the dividend yield on the all-share index against the S&P 500, really a large gap, 2.5% difference between that. And so to our minds, what this means is that the starting valuations for South African equities are as compelling as they've been going all the way back to the early 2000s. What does this all mean? If one had to now translate the macroeconomic backdrop into equity valuations and comparing those to different parts of the world. Given the backdrop that I described earlier on the macroeconomic side, one would expect South African equities to trade at a discount, and there would be strong arguments to be made that they should trade at a discount. We don't deny that. What we would say is that actually they already are. And the chart on the right-hand side just shows you by exactly how much. The gold-colored line is the all-share index. This is a forward PE rating. So we sit on a rating that is somewhere in and around 9.5 times. And you can see the discounts that this is trading on relative to emerging markets, the world index, something like the S&P 500. It has traded on these discounts for some time, but it is particularly stark and exacerbated right at the moment. So the starting point is important, and we think that picture gives you some description of the starting point. The other point that we would highlight is that we very much see income generation as a supplementary part of an investment case. If one can get a high starting dividend yield and some modest capital growth even, the total return that one can earn in investment often comes out actually quite well. And what you can see in the table below on the left-hand side is that the starting dividend yields of many companies sits well in excess of 5%. And we give you a few examples of businesses that we would own in the portfolio there that have starting dividend yields in many cases as high as 7%. And that we think is important context. What I'd now like to do is just give you a sense of the portfolio positioning and why we are positioned as such. And put that into context. The first slide which I'd like to talk to is just that if one looks at the composition of the all-share index and the domination of a couple of themes and large shares, it really is quite noticeable. So if you had to look at the top 20 shares in the top 40 index, that makes up 82% of the index. The top 20 shares make up 71% of the all-share index, really quite significant. When it comes to themes, the chart on the bottom right shows you that the combination of resources and Naspers and process make up 40% of the capped SWIX index. And we think it's important to be mindful of this. This does carry risk. If those themes do not work, and the combination of those themes do not work, we think you've got to be very wary of that. And we think it's incumbent on us as managers of a portfolio to ensure that we can diversify clients' risks away from that risk and the dominance of those two themes. What we show you on the left-hand side there is that we have a spread of different sized companies In many instances, we would be there are no other external analysts covering these companies. There's very little research available, and we would be doing our own proprietary work on that. What it results in on the pie chart on the right-hand side there is that we have a split in this portfolio between what we would call large cap companies in excess of 100 billion rand market cap, medium-sized companies in excess of 30 billion rand, and then small and mid-cap companies, which would be somewhere between 10 and 30 billion rand. We think many of these companies offer attractive returns, and we think that it's important if those investment cases stack up and are attractive, that it's incumbent on us to provide clients with exposure to that and to diversify away from some of those key themes and risks that I identified earlier. And just to give some context as to how we manage this portfolio, we set ourselves portfolio construction guidelines, which we adhere to very strictly. We don't like to exceed 30 holdings in the portfolio. We generally have in and around 25 to 28 holdings. We want to make the decisions count, but we don't want to overexpose the portfolio to any particular share or theme. And so we set ourselves a minimum weight of 1.5% in any investment, and we cap that out at a maximum of 10%. In the portfolio. What we're giving you on the left-hand side is just a good sense of our key and largest holdings. I'll maybe highlight a few of them, which we would regard as differentiated holdings. I spoke to the whole theme of renewable energy in South Africa earlier. We think a company like Reunert is extremely well placed for something like that, and it is one of the largest exposures which we have in the portfolio at around about 6%. And then we have a number of other mid-cap ideas, Carp Agri, AECI, and other businesses which we think add the potential to contribute meaningfully to portfolio returns. Putting that into context, this is a bottom-up analysis. We've left out the names so that it's not too inflammatory, but the right-hand chart shows you what our 3-year prospective returns and estimates look like for a number of the portfolio's key holdings. The horizontal green line is inflation plus 4%, so roughly 10% there. And as you can see, we estimate that the 3-year returns for a number of these holdings are well in excess of 10%. Some of them may play out quickly, some of them may take some time and need some patience, but we certainly hope that those returns are things that can be delivered on. Just to give you some sense of our confidence in the return expectation for South African equities, this is a snapshot of the asset allocation of our balanced fund, and we have approximately 54% of our balanced fund, which is sitting in South African equities as we stand, just to demonstrate how we've moved in that manner. I want to maybe just sum up on performance and a conclusion, and then really happy to take any questions. This table just gives you some sense of the performance of the Clucas Gray equity fund over the past year. It's delivered returns of just over 13%. The index has given you just under 4%, 3.8%, and so the returns are around about 9.5% better than the index. The 3-year compound return is running at 21%. Clearly, you've got quite a recovered base post-COVID in those numbers, but nonetheless, a pleasing number for clients. The 5-year returns are more modest than we would like them to be, below our objective of CPI plus 4, but 9.4% over that 5-year period. So returns have come through okay, despite a difficult macroeconomic backdrop. Maybe just to sum up, and then I'll stop there. But we still see numerous attractive opportunities in the domestic landscape. There is certainly uncertainty around the earnings backdrop, but the counter to that is a very strong valuation support, with valuations at levels that we really haven't seen for a long time. The power issues are, of course, something for concern. And in the near term, we see a catalyst for growth for some industries, some businesses. But as we said earlier, we don't want to sugarcoat the issues that surround that. The cost of capital is high. We need that to come down for us to be able to enjoy better returns. And we think that the ingredients are there to potentially happen in the second half of this year as inflation begins to come under control. The one thing that's certainly been apparent in the landscape is that there's been quite a lot of corporate action in listed companies. We think this highlights the opportunity set. We've had, over the last 3 to 4 years, 4 of our portfolio companies have been purchased through corporate action, and we think that if ratings stay this low, that's a trend that is probably likely to continue. As ever, we think patience is required. Returns don't come in a linear fashion, and we think that one needs to stay patient. But let me leave it there and see if I can take any other questions.
Great, very good, Grant. Thank you. That was certainly a whirlwind tour of the expectations in the South African market. We have a few questions, and they seem, because you had quite a strong emphasis on South African banks, and there's been a lot of talk, a lot of news in the international scene. The first question is, are there any of our SA banks that might appear undercapitalized and get us back to a situation that we had a few years ago with African Bank?
Thank you for the question. Jim, our observation is that is not the case as things stand. What we don't want to be is flippant about, banking crises. They certainly spark fear in markets and in banks. South African banks, as we've just seen in very recent results, are extremely well capitalized. And we think that the issues that have been apparent, certainly in the US banks, in the funding structure, is not a characteristic of the way in which South African banks are funded. So we think that the contagion effect onto South African banks at this stage would appear to be extremely limited, and it's not something that we are overly concerned about at this point.
Okay, Grant. And then the second banking question was, you seem to like ABSA and Standard Bank. Why do you prefer them over Nedbank and First Rand?
Yeah, I think that that's a great question. I think that in the case of ABSA, we think that this is a business that is really post its separation from Barclays has gone about its business quietly. We see a good improving trend in ROE and in earnings. We think that we are coming off an extremely low valuation base. We're talking about a PE rating for ABSA that would be in the order of 7 times. And at today's price, we estimate that the dividend yield is actually higher than the PE. So that to us makes it an attractive entry point. We do also have First Rand in the portfolio. It is a third bank. We think it's a bit of a cop-out to own all of the banks. And so we own 3, and Standard Bank and ABSA are the largest 2 holdings. And the primary reason for that is the valuation support that we see in those 2. First Rand is priced at a premium to both ABSA and Standard Bank. Standard Bank, of course, gives you the additional vector of growth that comes from their exposure in Africa. it's not always a vector for growth. It's sometimes a vector for problems and challenges. But over time, they've generated decent returns out of the continent.
Okay. Grant, I'll have to make this the last question for you. Does the world have enough basic minerals to achieve the objectives of the zero carbon that the politicians are telling us we need to do?
That's a great question. I really do not have the answer to it. A lot of the material that we read is that the answer to that is no. Certainly, that the volume required of specific materials to go into a zero emissions, heavily reduced carbon emission economy is not there at this point. Glencore certainly will tell you that. They don't think that copper production is at a level that can meet demand, and therefore are confident on what happens to the price of copper with a medium to long-term outlook. I would be speaking out of turn on other specific minerals. In aggregate, we think that the volume of production required has a way to go to meet all of the demands of a modern, lower carbon emission economy.
All right. Sorry, Grant, I just getting my mic working. Thank you very much. That was excellent. We really appreciate the time and the diligence put into the presentation. I'm sure that our clients are feeling a lot more secure in these times that we live in. And as you say, it's a strange thing about South African equities. They give us these inflation-beating returns despite the fact that we think that nothing's going right in the economy. So thank you very much for pointing that out, Grant. And we'll have to let you go now. And
well, thank you, Jim. Appreciate the invitation, and to the audience, thank you for your time.
All right, Grant. All the best. Ciao.
Thank you.
Bye. And this leads us on to introducing Tony Bell. Most of you will have heard Tony's name many times. In fact, Tony has been looking after equities and assets for us, getting on close to 10 years now with various portfolios for financial fitness. In 2015, we started a portfolio with Tony called Global Marathon. And that portfolio added to Tony's 8 other Raging Bull Awards, because he walked away with the Raging Bull Award for this global flexible fund in the 2022 award ceremony of just last month. So we just keep getting great results from Tony, and we've had many a laugh over the years, and this time it's on the Federal Reserve, Tony. Last year we were hearing about transitory inflation, and now we've got this very persistent inflation. So what is the difference between transitory and regular inflation? And apparently it appears that there's just many more stories out of the Federal Reserve is the only difference. So I think that that might be the only way we can sort of try to make sense of it. But that's on a flippant note. But Tony's going to make it clear to you what is his opinion about how the Fed sees 2024, what matters most, and inflation or recession in those calculations. So without any further delay, I'm going to hand this mic over to Mr. Tony Bell. Thank you, Tony.
Thank you, Jim. Evening, everyone. Thank you for your time. It's been a particularly volatile period in markets. I hope to add some perspective tonight and bring a sense of calm, but also to be realistic in terms of how I see the risks and how I'm positioning the fund. Jim asked me to deal very specifically with the question of how important inflation or recession is. For many of you that have supported the journey of Global Marathon, firstly, thank you very much. And secondly, if you've listened to me speak over the years, I think you would have come to be more comfortable with the fact that my thinking is somewhat different from consensus, and tonight's not going to be any different from that. What's more important, inflation or recession? I don't think either are. I think the issue that I'd like to unpack for you tonight, away from the headline news that you get in the various media, is not inflation or recession. It really is whether financial conditions are tightening or not, and the rolling liquidity risks that we're facing at the moment. So I'll go into that in some detail. Just really as a testament to your support and the confidence you've placed in placing your client money with Global Marathon. Very nice long-term track record, good short-term track record. We picked up the fund on Jim's behalf 2 weeks ago, the award, sorry. Line A on the screen is the fund performance, line B is the sector aggregate. And that's a very comforting position to reflect to clients. So thank you for your confidence all those years ago and support. So let's get into the Fed. I will try and be kind, and I will try and be representative of the actions that the Fed has taken. But I think that the Economist really does capture it rather well. In 2022, we were told that inflation wasn't going to be a problem. We've had one of the biggest backups in real rates in history, and I'll get onto the whole basis on which to view the Fed's pronouncements and actions. But I think that the key here is to perhaps look beyond what the headline is screaming at you. It really isn't just about inflation. There's a lot more going on. So let me unpack that for you. To understand where we are today, you've got to go back in time a little bit. There's a lot of talk about Volcker. I had the pleasure of meeting Dr. Volcker. He was up on stage. He apologized profusely. He didn't know that he was going to be on stage, and his quirk as a central bank is bright-colored socks. And he had on that day 2 yellow socks with Donald Duck on them. It's no reflection on the man. He is an absolute intellectual giant. And the thing about Volcker that is important to appreciate is when he came in 1984 to quell the systemic inflation of the 70s, he raised interest rates in the Fed to just under 20. And so what you see on the screen is an important context to what we're dealing with today. The dotted line is the Fed fund rate. That's the rate that we're all familiar with, that the Fed sets at its regular meetings. The black line is the year-on-year inflation rate. And you'll notice until 2008, a little bit in the Greenspan era, the rates were largely positive. And that's an important reference point as to what the Fed is trying to do. In order to bring inflation down, the Fed has to reestablish real interest rates. It has to establish them at about 2% above the current level of break-even inflation in order to get inflation down. So the Fed, when it says it is focused on inflation, is only part of the explanation. What it's really trying to do is get the dotted line above the solid line. And when it gets to the point where the solid line falls below the dotted line, it will be comfortable that it has achieved its objective. So what does that picture look like? Unfortunately, I sent this presentation through to Jim only 2 days ago, and it's already out of date. the market has repriced where it thinks the Fed is going to end up. And what you can see on the chart is the actual sequence of interest rate hikes by the Fed, probably one of the most strongest series of hikes in modern times. And then you can see the market trying to grapple with where the Fed is going to go next. All the dotted lines and the solid lines just give you where the market prices the forwards, price the Fed fund futures at different points in history. The thing that you will read a lot about and hear a lot about is the pivot. There's one thing you take away from tonight is please don't pay any attention to the pivot. It's not really relevant. Why that's important is the pivot in the past, when the Fed looks to reduce interest rates, has been a primary tool used by the market in assessing whether better growth will come down the track. The Fed doesn't need to do anything to the US economy. It's still growing rather strongly, as I'll show you. So the Fed pivot is an analysis that is out of context. The real issue is the real interest rate pattern. So what one should rather be focusing on is what the Fed funds rate is going to be to establish the level of real interest rates that Powell is comfortable with in bringing inflation under control. And the Fed has no need to pivot. The Fed has a different crisis to deal with now, which I'll get onto, but it's not about pivoting. So I think the inference that somehow the Fed pivot will start to shape both the equity markets in the US and the bond markets is a little bit short-sighted. The other big topical point at the moment, and thanks to Grant for an excellent presentation, is the sort of prognostication or the prediction that the dollar has entered into a sustained downward trend. I'm not prepared to take that view yet, or I'm not comfortable to take the view yet, because the real issue that we're dealing with is not an inflation crisis. It's a liquidity issue. Inflation will come down. Inflation is being driven at the moment by supply side normalizing. The next phase of the down leg inflation, and we saw part of it last week on Friday, was the demand side of the US economy will get a lot weaker, and that will naturally bring inflation down. The thesis that somehow the Fed will pivot, the ECB will continue to raise interest rates, the interest rate differential will narrow and will bring the dollar down, ignores the current issue that's taking place in the banking system. 2008, we all need to remember that there was about 10 months between Barings and Lehman's, and when you've raised rates on a sustained basis for as long as the Fed has, and you've raised real rates from -1 to +1.5, something could break. And what one looks for in that statement is something in the banking system or something in the credit system. And it's normally a duration mismatch. There's something that goes wrong, as it did with Silicon Valley Bank and others. And I see today Credit Suisse is in the headlines, and the Swiss Reserve Bank has called a meeting today to review the Credit Suisse position. So I'm not really ready to predict the dollar's decline yet. I do think that there is a contrary view that says that if we do face a sequence of additional liquidity-driven events, we need to watch the dollar very carefully. We need to watch the US 2-year rate very carefully and the US 10-year, because those will be the primary transmission mechanisms through which risk is telegraphed. If we see the 2-year and the 10-year falling and the dollar rising, that's a bad signal for risk, because the bond market would be saying the economy is getting a lot softer. inflation's falling and we're starting to get disinflation, and folk would be buying bonds through the dollar to go risk off. So that would be an important signal to watch for a more generalized risk off environment, together with the VIX index. And for those of you that are more familiar with it, the MOVE index, which is the option volatility index, which has shot up to levels in the last week well above the top band on the graph in the bottom panel. So what the market is telegraphing is that it is watching very closely as to how central banks deal with the balance between raising interest rates in order to reestablish the real yield pattern, in order to bring inflation down, and in the process creating financial tightness, which in turn leads to financial stress and the potential of a liquidity-driven event. The other thing that the central bank or the Fed is not telling you about, to use the colloquial expression coined by Donald Trump, they're draining the swamp. And this is a very important indicator to watch in the context of where risk assets go to next. So to explain it in very, very simple terms, the gray line is the money supply in the US, and the dark line is US inflation. When we all went into, or when the world went into COVID back in 2020, early 2021, sorry, 2020, seems like a long time ago already. Yeah, it was 2020. The US started to increase money supply. So this was the helicopter money that was sort of phrased after Dr. Bernanke. And to put this in perspective, read off the left-hand scale, the US had about 50 trillion in notes and credit before we went into COVID. By the time it reached the peak at virtually the end of the COVID cycle, it had increased that money base by over 25%. That is a huge amount of new money filtering into a system that was largely contracting because of supply side constraints during COVID. Powell's primary objective is to drain the swamp and reestablish real interest rates. And so what the Fed has been doing is curtailing the extent of new money supply to the point where we have now virtually moved into negative territory. This has created much tighter financial conditions, along with the raised interest rates or the higher interest rates, and the combination of less liquidity plus higher interest rates creates the financial stress that we're seeing at the moment in the regional banks in the US. And the unanswered question is there contagion going forward? So why is the Fed so obsessed with raising interest rates? There's a concept out there called sticky inflation. And sticky inflation, which you could find off the Atlanta website, is core inflation minus food and energy. So it looks at that component of the inflation, overall inflation rate, which is considered to be less variable than the movements in food and energy prices. And you can see that indeed it is rather sticky. And so the Fed is looking to try and create sufficient tightness in monetary conditions without breaking something. It talks about a soft landing. When banks start getting into difficulty and they're liquidity-driven events, a soft landing becomes a lot more difficult, because one is starting to see more and more stress in the primary banking market with the regional banks, not so much in the big banks. We had the big banks in 2008, but not surprisingly, if you have a look at the reason why SVB has gone into receivership, is it's the same problem we had in 2008. They took in a lot of deposits, they couldn't lend it out. They went into the mortgage-backed security market. They didn't adequately match their lending book and their investment book, and when rates kicked up, they found themselves rather at the wrong end of the of the duration curve, and they had to incur losses. When we started off in 2023, the Wall Street Journal, I think it was the 3rd of January, published about 500 preeminent and eminent strategists' views of 2023 into 2024. And the narrative went something like this. 2023 will see a recession. The Fed is near the end of its rate cycle. Inflation will fall. The Fed will pivot. We'll have a short and shallow recession, and we'll get through that by the 3rd quarter of this year, and we'll start to recover in 2024. I'm afraid most of those strategists have scored about a 0 for their insight. The world doesn't look anything like that. Inflation is sticky. The Fed has had to keep interest rates high to induce a demand side contraction in the US economy. Money supply itself has been tight, and we're starting to see the signs of liquidity driven stress. So this was the IMF's GDP forecast about 2 weeks ago. What you can see on the vertical axis is what the IMF forecast for 2023. A lot of it was very positive, and most of the revisions were upwards. Without scaring you, the one thing that I'm fairly conditioned to look at as a fund manager is recessions don't just happen. They happen because something else happens. And the something else happens because of a liquidity-driven event or a currency break. I think I've been through about 7 or 8 bear markets, 7, starting in 1987. And almost every single bear market is driven by a liquidity-driven event. Recessions happen as a consequence of something breaking within the economy, and that's a really important takeaway from tonight. So when you look at GDP forecasts, my best advice is pay very little attention to the IMF's revision of these forecasts or the levels, because if something does indeed break in the system, these forecasts are going to be fairly cold comfort. So I think the inflation growth narrative is a little singular. Where does that put us in terms of equity markets? This slightly busy chart shows you all the equity bear markets going back 60 odd years, and very important to look at the anatomy of a bear market. There are 3 very distinct phases in bear markets through history. The first phase is quite short, 6 to 9 months. It's characterized by equities coming down as a result of price earnings multiples contracting, and that's largely driven by interest rates going up. So when central banks raise interest rates, market says we've got to value equity earnings growth at a lower multiple, and the bulk of the first phase bear markets typically are interest rate adjustments. The second phase, there's a very clear switch over into an earnings decline. So for the market that we are experiencing at the moment to move into a second phase of the bear, in other words, testing the lows of October last year, there would have to be a convincing argument that earnings are going to collapse. And I don't really see that at the moment. It's not my base case. So the first takeaway from where we've got to in the presentation is the central banks are alive to the liquidity risks. Very, very low on the published scale is the extent of money that the Bank of Japan, the Bank of China, the Bank of England have injected into the market year to date. The number is in the order of 3 trillion. Why have those liquidity injections taken place? The Bank of Japan is defending its yield curve, and it has bought an enormous amount of bonds in doing so over the last few months. The Bank of England was dealing with the Truss affair, and the People's Bank of China is trying to stimulate their economy because of a number of policy errors by Xi that have flip-flopped on key issues and proved not to be that prescient. So liquidity that was tight is starting to ease up. The bond market in the US is telling us that financial conditions are getting easier. When yields drop in the US, even though you see the inverted yield curve, interpret the inverted yield curve not as a great predictor of recession, but think of the short end of the yield curve as being tight monetary conditions imposed by the Fed, the bond market where yields are coming down, easier financial conditions. That provided a very nice underpin for equities. In fact, in January of this year, as I'll show you shortly, produced one of the best returns on long duration tech stocks in 35 years. And that shouldn't have happened if the world was going into a recession with an earnings decline. So the reason why I at this stage do not see these rather large declines in second and third phase is that I think central banks are very alive to liquidity. Yellen has come out, she's guaranteed all depositors, no run on banks, and liquidity will have to be dealt with structurally by the various central banks by putting money into the system, not taking more money out. So the second phase is characterized by earnings decline and further PE multiple as the market assesses growth to slow. And then the much spoken about capitulation trade really are these last legs down where investors just simply throw in the towel. And I don't get a sense that we're anywhere there at the moment. Why is this core inflation an important argument? If you have a look at core CPI versus an S&P ratio, there's a relationship that is reasonably strong. And the basic takeout from this chart is that the higher core inflation goes, the lower the multiple. So what the market's grappling with at the moment is while headline inflation is expected to come down to about the 2.5% based on the current break-even inflation curves, the Fed's real objective is to get sticky inflation down to that lower level, and that should translate into a PE of around 23 for the S&P 500. So I've run some basic numbers for you here and just looked at different earnings bases. The current estimate's around 224. The current market is sitting just under sort of around 3,800. I see the downside as being reasonably limited. You will see in the portfolio when I present it to you in a short while that we have a significant amount of cash in the portfolio, and I'm seeing it as an opportunity, but I'm very mindful of managing the liquidity related risks in the moment. I didn't want to be dramatic, but I just wanted to include it as a reminder. SVB Bank, Bearings, question mark. No one paid any attention to Bearings until Lehman's came along. And then, of course, the structural mistake that the Fed made was they let Lehman's collapse, and that's when the floodgates opened. So something that's not spoken about a lot, but is very much on my radar screen is currency risk. Particular reference to the yuan or the renminbi, Chinese currency. What you've got on the screen in front of you is the black line is the difference between the US and the Chinese 3-month rate. And the simple takeout is that the more the Fed pushes rates higher, which was a very real risk until last week, the greater the probability that something would break in the rest of the world. In 1998, I remember the Thai baht went and we had the Southeast Asian emerging market crisis. You go back in bear market history, there are a number of events where currencies broke in addition to banks breaking. And my concern here was the Chinese renminbi or yuan. The more the Fed pushes on that piece of string, the greater the dislocation is between the fair value of the yuan and the 3-month interbank spread. And I don't think for a moment Xi is going to be foolish enough to attack Taiwan. That doesn't keep me awake at night. The devaluation of the Chinese renminbi keeps me awake at night. For those of you with memories going back into the past, you may recall early August 2015, the Chinese decided, based on that very small move in the interbank rate, to devalue the yuan by a modest 3%. I think Wall Street fell 10% that night. So the bigger risk for me is not recession risk. The bigger risk for me is a liquidity-driven or currency risk, which central banks have created through their very tight monetary policy, and that is a risk that could create drawdown risk for equities in the moment. So how I try and figure out what to do in the portfolio is based on a model that I run for tactical asset allocation. It's a very simple model. On the horizontal axis, you've got the volatility index, the VIX, and one can read that off every day. And the vertical axis, you've just simply got the difference between the long bond rate and the short-term interest rates in the States, averaged over 2 years. The top left-hand quadrant is called stimulus. The bottom left-hand quadrant is growth. The bottom right-hand quadrant is contraction. And the top right-hand quadrant is called recession. And the reason why that's rather important is if you take the position of this indicator and you have a look at what the sector returns are that you could expect from investing in the 11 sectors of the MSCI, the picture is very, very different. So when you're in a growth phase, not surprisingly, technology does very well. When you're in a contractionary phase, energy, healthcare, and utilities do far better. When you move into a recessionary phase, there's a sea of pain in energy and financials, but consumers hang on to reasonably acceptable returns, and technology strangely does a little bit better because of its inherent growth characteristics. And when you move into a stimulus phase, not surprisingly, the sectors that are geared towards a early stage recovery of the US economy do relatively well. So why did we position your portfolio for tech stocks at the end of last year and enjoy the benefit of the tech run in January? It was very contrary to what most commentators would have expected. And the reason was that I saw volatility dropping as the Bank of Japan, as the Bank of China, as the Bank of England injected massive liquidity, and as financial conditions eased, and by that I'd reference you back to the earlier comment, while the Fed was tightening, the US long bond was easing, so yields were coming down, and that combination reduced volatility and reduced the spread between the 2 and the 10-year, and the market moved left. We had a really good return from technology. And the question is, well, where are we now? So keeping this picture in mind, if you look at the Smarty Box chart of sector performance for the year, we've got a couple of signals that are starting to worry me a little bit. Financials, if I update this chart to today, this was only done last week, are right down at the bottom with energy and healthcare. And if I take you back to this picture here, you can see that the standout is energy and financials do really poorly. So one's got to be very mindful of the signaling that's coming through from the market. This chart updated just a week later would drop consumer services and discretionary right down, puts information technology at about 12. So the market is starting to give some signaling that it expects growth to slow and that it is a little concerned that the Fed may have overplayed its hand from a liquidity perspective. So the consequence of that is I've positioned the portfolio rather defensively. we're sitting with over 25% in cash. Normal cash levels in this portfolio would typically be about 15. We sold about 10% of the portfolio in early February, after the big run in January. And I repositioned the portfolio so that what we had at the top of the portfolio was a fairly defensive positioning with the focus on companies that I believed could continue to generate good growth. I have, subsequent to February, taken further profits on Apple, Alphabet, Eli Lilly, Nvidia. We've eliminated Johnson & Johnson. So there were about 9 holdings in March that had been significantly reduced in the portfolio, and stocks brought in to improve the defensive quality. Remembering this is a long-term growth portfolio, at the moment the portfolio is positioned quite dissimilarly from the past, where we would have had stocks like Nvidia, ASML, AMD, Lam Research, the high-tech, high-octane stocks within the top 10 holdings. At the moment, only Nvidia sits in that top 10 positioning. So just to conclude, before I hand back to Jim and to try and summarize everything for you, I think inflation in the US will decline in 2023, but it's going to stay sticky. The Fed is near the end of its hiking cycle, but I'm not banking on a pivot. I think the US bond yields have started to reflect the higher base case in the inflation outcome. And really, I would just draw your thoughts to a conclusion by re-emphasizing that the inverted yield curve is not a guarantee of recession. It's rather an indicator of financial conditions being tight or loose. And I think central banks have got a bit of a fight on their hands to try and deal with these rolling liquidity issues. And the major risk there is that we have a dislocation either in a liquidity event or in a currency. And then Anton just asked me to include, and Jim can comment on it, after a number of years of enjoying being able to invest internationally through the ZAR-based Global Marathon Fund. We've now launched Jim has launched in partnership with my plan, the dollar version. It's had a good start. It started on the 1st of March, and I'm pleased to report it's trading very nicely. On that note, Jim, I'd say thank you and hand back to you for question time.
Indeed, thank you, Tony. Thank you for mentioning that. I was going to mention that with regard to our new USD version of your global macro strategy, which is a very, very similar parallel strategy to what you've done for us with Global Marathon. So clients, I think you'd be happy to remember or realize that you've had a significant portion of your offshore exposure with Tony's Global Marathon Fund, and now we've got the USD version. So that's great news. It took quite a while to get there, Tony, but
yeah, it did, Jim.
We got there. So
they're in the end, and it certainly launched at the most interesting time.
Yeah, we always manage to find great times to get started with new adventures. Yeah. Here's a question from Gary, and he's been asking a few questions this evening. What do you think is going to be the consequences if the Federal Reserve gets its own USD central bank digital coin? Tricky one.
Yep, I suppose the question indirectly relates to crypto. I think it's inevitable that central banks cannibalize the blockchain technology and digitize currency. If you're interested in a really good book, James Rickards wrote an excellent book in 2013 called Currency Wars. And ultimately, it's about decommercialization of paper currency and the digitization of all currencies. Where blockchain fits in, I mean, where Bitcoin fits in the whole thing, I still haven't quite got my mind around. I've tried to trade it. I find it quite obscure, but I think the biggest risk to a limited edition crypto or any of the cryptos like Bitcoin is that it really isn't. It doesn't fit within the broader definition of modern monetary theory. Without going into the complexities of it tonight. I think the central bank, the Fed, is likely to maintain control over the digitization of the dollar for a number of years to come. And while Bitcoin and other crypto go up and down, it really isn't core to the system. The trading mechanisms, the settlement mechanisms, it's just not on the scale of what the dollar and the euro and the yen combined offer the world. So I think it's inevitable, Jim, that blockchain will be used to digitize these currencies.
Okay, Tony. Now here's a question that our financial advisors have to answer every month. Why would I invest in a diversified portfolio, and take that risk when the banks are currently paying 8 or 9% on deposits?
Yeah. Well, I think there's a place for both, Jim. I mean, at the moment, something like the Global Marathon has managed to beat, as I showed in the early slide, its compound return is well in excess of what the banks have offered over time and even over recent periods. I mean, the return on January alone on some of these stocks were north of 40% in a single month. So I think it's about the balance of the risk apportionment amongst your clients. I have taken a significant portion of Global Marathon, 20%, and invested it in the JP Morgan short-term income fund, as well as putting it on call. And that's giving me about 4.75% in USD. And I find that attractive at this point. So being a flexible fund, I can balance the risk reward across the asset allocation in the fund without having to take a singular bet. And from a client perspective, of course, the 9% is pre-tax. So, you know, if Nvidia can't beat 9% pre-tax over the next few years, then I think there's going to be a problem.
Right. Well, I think we've maybe got time for 2 more questions here.
Yeah.
One was based on the recent sort of lower or reduction in subscribers for Netflix. Why does it continue to look like a good investment?
It's because they changed their revenue model, Jim. You know, the family sharing concept was a breakthrough for them on their pricing model. And I think that, together with the way in which they are outmaneuvering Walt Disney in terms just of innovation, does give me one of the few choices in that sector to make. My choice in that sector is a choice between some of the gaming companies, Walt Disney and Alphabet, and I've taken a fairly low-key view on Alphabet. I think chatbot GPT is not going to decimate Alphabet's search engine, but it certainly is going to impact their revenue model. And it's often when one invests in high growth stocks, you've got to be very cognizant of the change in business model or the threat to the revenue stream. And I don't think Netflix is going to necessarily be a holding in the portfolio for the very long term, but it does act as a very nice partner stock in that sector. And it really is held for the change in the business model towards a different revenue focus.
Okay, great, Tony. And then the last question, pretty easy question, really. How much are you going to make for us in 2023?
Yeah, that's an interesting one, Jim.
Yeah.
The short answer is I really have no idea.
Yeah, I know.
But
No,
I think the beauty of this fund is, A, the flexibility, and secondly, the thing that is often not recognized in that long-term returns chart that I showed is that the returns, that return profile hasn't really come from just picking great stocks. It's actually come from aggressively managing the drawdown risk. And I think that's an often overlooked position. So I'd almost answer the last question in reverse, and I'd say, I'm not sure of what I can make for you, but I'm very focused on what I won't lose for you.
Great, Tony. Good answer. So, we can tell, and our clients know that they're in safe hands with the portion of money that you manage for us on their behalf. Thank you for reminding us that the now Global Macro Fund is available in USD. So all of you clients who are sitting there with dollars, sterling, and euros under your relatives' mattresses, we've got a better place for it. So once again, thank you very much, Tony. We will look forward to speaking to you again at some point in the future for updates on how our money is doing on the global scene. So thank you. Stay well, and we'll. Oh, by the way, it's St. Patrick's Day tomorrow. So for all of you, Sláinte, and please have just 1 pint of Guinness at least. All right, Tony, all the best. Good night.
Thanks for the invite. Thank you, everyone, for your time tonight. I hope it was useful.
Indeed. Thank you.